Welcome to the Business Tax Roundup for this month. My name's Dean Wootton. First up, we're going to look at underdeclared property income. And Mr. Nash, Tom Nash, was a property developer and he's registered as a self-employed person. He submitted returns for 0607 onwards, but he didn't declare very much profits at all, sometimes small losses. Now HMRC opened an inquiry into his 1314 return, requesting details of all property transactions since 2008. HMRC closed inquiry in March 17, and they made a number of adjustments based on their findings. Now, interestingly, HMRC calculated his turnover from 0506 through to 1314 based on his expenses. And the idea was that he was unlikely to understate his expenses, so therefore they multiplied his expenses by 2.5, and in most other similar businesses, that relationship, multiplying expenses by 2.5, would give turnover. And that's what they did to Mr. Nash. Now, income from the sale of property was added to his turnover for 0708, so just a one-off year, that one, as income from property development. There was also funds received from his brother-in-law. They were treated as self-employed income. There was a lack of evidence, so they just assumed it was sales. And there was also a gain on disposal of land that was liable to cover gains tax in 1112. But the key, really, was the 0506 through to 1314 expenses multiplied by 2.5, giving the income for all those years. Discovery assessments were issued by HMRC for 0506 through to 1213, and penalties were charged for all those years. On the 20th of February 18, Mr. Nash appealed to the First Tier Tribunal. Now, unfortunately for Mr. Nash, the First Tier did not accept his argument. He argued that he earned little or nothing from being self-employed, and the property purchases and renovations were funded by inheritances and remortgaging. So therefore, the income they said he had wasn't from trading activity. It was from inheritances and remortgaging. Now, the First Tier Tribunal accepted HMRC's stance, and the appeal was dismissed. Next up, we're going to look at a CIS case, gross payment status. Obviously very valuable for companies and businesses that have gross payment status, and you don't really want to lose it. You want to be paid gross rather than under deduction of tax. Now, RMF Construction Services filed its corporation tax for 2010 late. There was a number of other compliance failures, including late CIS returns and a late P35. And obviously, when you've got gross payment status, you don't really want to have any compliance failures, because there is a risk that you'll lose it. Now, HMRC did not accept that the company had a reasonable excuse for all those late returns, and they sought to cancel the company's gross payment status under the CIS. In December 12th, RMF Construction Services appealed to the First Tier Tribunal. Now, rather strangely in this case, the appeal was stayed behind another case, which is JP Witter Limited. And consequently, the First Tier Tribunal did not decide this case until 2020, some 8 years later. Now, the company accepted that the compliance phase back in 2012 had taken place. There was no dispute on that. But withdrawing gross payment status 8 years later was wrong in their eyes. The company argued that if it were to apply for gross payment status now, it would be granted, because they were fully compliant and had been for a number of years. So they're almost saying like the failures 8 years ago were irrelevant. It's not what they're doing today. Now, the First Tier Tribunal allowed the appeal. The 8-year delay in withdrawing CIS gross status was disproportionate. The CIS compliance system sought to encourage compliance, not to punish non-compliance. Now, the threat of withdrawal had achieved the desired result. The company was now fully compliant and had been for quite some time. HMRC were not letting go, though. They appealed to the upper tribunal, just on gross payment status. Now, in the upper tribunal, the company's 2012 compliance failures, in the upper tribunal's mind, did give HMRC grounds to cancel the gross payment status. The 8-year delay was not relevant. The legislation sought to ensure that everyone was treated in the same way, irrespective of appeal or not. Under the scheme, penalties are issued for non-compliance, and avoiding penalties by subsequent compliance would undermine the CIS system. And rather harshly, it was not relevant that the company might fail as a result of removing gross payment status. So HMRC's appeal was allowed. It's almost like this is a demonstration case. And HMRC is saying, look, if you got gross payment status, you have to be compliant. They weren't, so they want it removed. And it was removed, unfortunately. We now look at a plant and machinery capital allowance case, the Cheshire cavity storage case. Now, as suppliers of energy, the companies built underground cavities to store gas. And they were trying to argue that these cavities were plants, performed a function in the business. Now, the cavities were created by a leaching process to dissolve the rock and a debrining process to exchange the resulting salt water with gas. Now, the companies claimed capital allowances on the leaching and debrining expenditure. But unfortunately, both the first tier and the upper tribunals dismissed their appeal. So up to the Court of Appeal it went. Now, in the Court of Appeal, it was held that no man-made structure or equipment was put into the cavities. They were not artificially lined. Cushion gas was introduced into the debrined cavities to prevent the cavity collapsing, the same effect as a beam, giving stability to a formal structure. As far as the Court of Appeal was concerned, the cavities were little more than receptacles in which gas could be stored at high pressure. The appeals were therefore dismissed. It was just part of the setting from which the trader traded. So whilst the actual case itself is unlikely to have wider client impact, i.e. not many clients would have gas cavities, but it's just that fundamental concept that if you're claiming plant, it must have a function. It can't be just part of the setting in which you trade. On to VAT. We've got a case first up on charging for staff effectively. Now, in this particular case, both companies, that's the First Alternative Medical Staffing Company and Delta Nursing Agency Limited, both companies provided nurses and medical staff on a temporary basis to hospitals and care homes. They charged clients by the hour, covering the wage plus a commission element. But they charged VAT on the commission only, i.e. they were agents. And obviously that was positive for the people they were billing. The people they're billing are not in a position to recover VAT in the main. Now, HMRC raised VAT assessments on the companies for $2.1 million between 2013 and 2016 on the basis that the companies were acting as principals, and as such VAT was due on the full charge, not just the commission. Now, the companies acknowledged they were principals, but they argued that a letter from HMRC sent in 2004 confirming that VAT was due on the commission gave rise to legitimate expectation. This letter confirmed that fact, so they were relying on that letter. Now, the High Court agreed the letter had given rise to a legitimate expectation, but later HMRC public statements meant that they could no longer rely on that expectation. You can't rely on a letter that you know is out of date effectively, i.e. no longer correct. Now, unfortunately, there was a concession out there, the Nursing Agency's concession, which did allow exemption for charges such as this. But the companies weren't relying on that. They were relying on the letter, not the brief. And it was held, or argued in the High Court, and agreed by the High Court, that they could not rely on a business brief retrospectively. If you want a business brief, then you've got to apply it at the time. Now, in the Court of Appeal, it was decided that the concession to conditions were met, i.e. they could have got the Nursing Agency's concession. But the Court of Appeal stated that the companies had to choose whether to rely on the concession or a letter. And they were relying on the letter. You can't rely on a concession retrospectively, effectively. Now, the court concluded that ordinary sophisticated taxpayers would not interpret this brief as being able to be applied retrospectively. And they would have understood that a choice had to be made for each supply by the time the client was invoiced, i.e. if you want the brief, you rely on it at the point of invoicing. Now, the companies had not considered the concession at that time. They were relying on a letter. So unfortunately for the companies involved, the appeal was dismissed. Now, again, it's one of those cases where the actual point in there is not widely relevant in terms of nurses and stuff, billing. But the point about business briefs is, and you don't get these business briefs applied retrospectively. If HMRC bring out a favourable business brief, which gives certain taxpayers advantage, then they should rely on that at that time. You can't trade for a couple of years and think, hang on a minute, there's a business brief that helps us. Let's go back and apply it retrospectively. You can't do that. The Court of Appeal held that that was not possible in this particular case. So you must keep your eye out for business briefs and the impact they have on your clients. And if you want it to be applied, you've got to apply it at the time. We'll have a look at a VAT case on parking charges. Now, this company operated car parks on private land under agreements with site owners, and similar arrangements are very common in the UK. For example, supermarkets engage an operator to oversee and fix the rules for parking at their stores. And you quite often see that you're allowed to park here for 2 hours or 3 hours without charge. Now, the company set the conditions for using the car parks and imposed a €69 fee, control fee, if drivers did not comply with them. For example, exceeding the permitted time, or parking across a couple of bays, for example. Now, this case was about whether that control fee, that penalty, was subject to VAT. Now, the European Court concluded that such fees were subject to VAT. When they decided to park their vehicles on the site, the driver had to comply with the general terms and conditions for using the car park. There was a distinct link between the control fees and the provision of parking, and the penalties represented additional consideration for the excessive use of that car park. So if the terms were you're allowed to park for 2 hours and you parked for 4 hours, then you're effectively paying for 4 hours parking, and parking is a standard rated supply. Now, whilst this is a European decision, and obviously we don't pay too much attention now to ECJ decisions, they will have relevance, i.e. the courts could look at them in the UK on the same basis. They're not bound by them, but they would take them into account, into consideration, when looking at whether that applies or not. Let's now look at a case on exporting goods. Now, exporting of goods is zero rated. Now, in this particular case, the taxpayers bought and sold clothes and accessories. And they had one client in China who bought a lot of their goods. And HMRC raised assessments treating the exported goods as supplied in the UK and subject to the standard rate of VAT. Now, the evidence provided did not satisfy the requirements of zero-rated export. And you've got to hit those requirements. If you don't hit those requirements, proof the goods have gone, etc., then you don't get the zero rating. Now, in this particular case, the reason HMRC were denying zero rating because of the vague description of the goods, quantities or values. They were not acceptable. They didn't fulfil the conditions of zero rating. Now, the taxpayers claimed that the evidence provided was sufficient. Now, the category of exports was personal effects, which they were. The description of the items was okay. They were clothes. The total value on every shipment was £100. But the reason for the vague descriptions and low value was to avoid the theft of goods. In many cases, it doesn't really matter what the value is because you're exporting the goods. So therefore, they're zero rated. But they had good reason to put just a flat £100 on, irrespective of whether it was worth 500,000, didn't matter to them. They just wanted to almost hide the goods being on value so that they weren't stolen in transit. Now, the first tier accepted the need to use vague descriptions and a fixed value of £100. And they stated the evidence must be taken as a whole rather than looking at each document separately. Now, the packing list did describe each item in detail with a value per item. And they could cross-refer each item on a sample packing list, the client's order, retail sales receipt for the goods ordered. There was no suggestion that £100 was the value for the supplier for VAT purposes. The correct value was on the packing list. So the court allowed the appeal. The goods were correctly zero rated. They had the sufficient evidence to ensure zero rating. But I guess it goes to show that if you're claiming zero rating, then you've got to make sure the goods are zero rated. You meet the conditions. If you don't meet the conditions, then you drop into the default. And the default for VAT is standard rated. Well, that concludes the business tax roundup for this month. My name's Dean Wootton. Thank you for listening.